So basically, Ricky is someone that I've known for a long time. It's probably close on 10 years now. It was around 2012 that Ricky came on. I don't know, Ricky, if you can tell me if it was 2012 or 2013, but he came on his first buyer's trip to America, literally straight out of university. I'll let Ricky talk to his story, but I mean, as I understand it, within a month of finishing university, him and his dad came on a buyer's trip with us to America. Was it 2012 or 2013, Ricky? I can't remember.
I can't remember either. I seem to think it was like November 2012, and then we bought our first home in 2013, if I recall correctly.
Okay. So just to put in perspective, don't be bemused by Ricky's age, because this is him literally 1 month out of university. That's him there sitting at the table. So this is what we used to do. These were the old days, ladies and gentlemen, which weren't even 10 years ago, that if you wanted to invest overseas, you had to fly to America with us. You had to open bank accounts, you had to set up companies, you had to buy houses, etc. And that's Ricky there, and that's his dad. And what I've always found very impressive about this story is that although his dad, was looking to invest and diversify, it was Ricky that drove the entire process. So this was the two of them on the buyer's trip. This was us actually in a bank opening a bank accounts. Like I said to you, in the old days, there's actually a law in America called the Patriots Act, which has been around for 350 years, that if you want to open a bank account in America, you have to fly to America to open a bank account. So this was us in Wells Fargo opening bank accounts. This was us looking at apartments. So we're going to talk today about multifamily, and this is literally Ricky and us walking around what we're now going to learn about today, which is effectively a multifamily opportunity. This was us looking at houses, and in terms of in Atlanta, these were the type of houses that we were buying. Just in my interest, does anyone want to take a guess? Like, this is a 4 or 5 bedroom house, probably 180 to 250 square meters. How much do you think we were buying these houses for 10 years ago? Just take a dollar guess, basically.
I have no way of even beginning to guess.
Give it a flyer. Anyway,
I'll guess.
You can't go, Ricky, before you. Let's just see if anyone else. I'm just interested. Because I mean, they're proper houses. They're in estates. They're in everything. But anyone want to give it a go?
Is it $100,000?
Yeah, it wasn't not far off, Derek. Like ranging probably from 115 to maybe 140, probably. Yeah. Ricky?
Yeah, exactly.
And just to put in perspective, the dollar was 8.80 at the time to the rand. So you were yielding sort of 8% income, 8.80 to the dollar, and you were buying these houses at those sort of prices in terms of the process. And then the
you can't buy 30 square meters in Sea Point for that anymore, Scott.
Exactly. And then finally, this was us. We actually went to look at multifamily in New York. And I don't know, Ricky, if you're going to talk about it, but one of the things in America that's very, very important is that every state is different. So you've got blue states and you've got red states. And as much as we all wanted to be in New York, and you can see how much us as a bunch of South Africans really wanted to be there, because this was one of the coldest days of my life. Because I tried to wear like a proper work jacket because we were meeting some banker, and I've never been so bloody cold in all my life. But we went to look at a building that had 12 apartments there. But the challenge in what's called a blue state, which is you got the red states, which are the more capitalistic states, and you got the blue states like California and New York, where there's a huge amount of additional problems around tenants and taxes and all that. I don't want to steal Ricky's thunder, but these were all the things we had to learn 10 years ago, and it sort of sets me up for just explaining kind of who Ricky is. I mean, he's been in this game for the last 10 years. He did actually start with us at IPS. Well, as I said, he literally bought his first house when he was, I don't even know how old you were, Ricky, 21, 22 with his dad. So he's literally been in this game in America for the last 10 years. He then he went on his own and actually started his own company in terms of creative real estate. And I think what's more important, and I know, Ricky, you can talk to this, but is basically specialized in the multifamily sector over the last decade. And I think why this is really important is that if you look at not only the deal volumes, But what Ricky specialized in, and sorry, I know this is never easy for an individual to do it, so I'm going to blow his own trumpet. What he specialized in is doing the due diligence, the financing, looking into the quality of deals. So there's another partner of ours, Brendan Brown at Infinity. Ricky worked a lot with them to look at all their deals in terms of which deals were quality, etc. They work, he's working with this K Finance team, etc. And I think why this is important is that you're not learning today from someone that's just an educator and a good public speaker. You're learning from someone that actually knows the nitty-gritty of how to analyze what is a good deal, what is a good market, where's the opportunity, etc. So that was the reason that I'm very grateful that Ricky was prepared to join us and share his knowledge. Now, what do we want as a mastermind? Just to be very clear. As a mastermind, in my opinion, over a 12-month journey, if we can get a deep understanding each month of one asset class, so last month it was structured notes, this month it is multi-family, next month it's going to be medical commercial, I'll talk about that later, is that over the year, you will then have a much deeper understanding of each asset class with the idea ultimately of building your diversified portfolio. And when it comes to multifamily specifically, it's been the most resilient asset class over the last 15 years. So it wasn't seen as a very sexy asset class prior to the crash in 2008. But since 2008, a lot of the institutions and a lot of the investment money has gone into the space because it's had the best risk-adjusted returns. And again, Ricky, I don't want to steal your thunder, so I'm going to hand over to yourself. But it's an asset class that we, if we don't live in America, don't actually understand because no one's ever heard of multifamily outside of America. So just to give it very clear, if you live in England or Europe or South Africa or Australia, the way it normally works is you build a development, there'll be 200 units or whatever, and they get sold off individually to a bunch of individual investors who then buy an apartment and they try and manage it kind of one building at a time. In America, it's actually a commercial institutional asset where you own the entire building. So you own the entire thing. And again, with that basis, Ricky, if you don't mind, I want to hand over to you. But it's an interesting asset class because it's the name multifamily, as I understand it, only really exists in America. I haven't seen it outside of America, but it is one of the best asset classes to be investing in America in the commercial property real estate space. So without further ado, Ricky, over to you. And I hope everyone enjoys what they're about to learn.
Perfect. Thanks, Scott. I'm just looking over here for sharing my desktop quickly. Looks like we've got to just switch some preferences for Zoom. So as you can see, Scott said, not just a good speaker and presenter, but I live and breathe it. Quite the opposite. I'm not the best presenter or speaker, so bear with me. But I do live in this stuff every single day. So I'm just, Scott, I'm going to have to drop off and log in order to share my screen. So give me 1 second.
Okay, we'll do that. Vilko, while he's doing that, I went to get this book and I forgot to share it with you. So I literally bought this about 2 months ago. It's just come out, and it's an interesting one because I haven't done it yet, so I'm not going to lie to you, I haven't. But what I liked about it was it took his principles, and then it's like a journal to kind of take the principles and to kind of create your own principles, but like sort of it's like it's a working guide, if that makes sense. So I have bought the book. That's all I can say. I haven't yet. I have not done it yet myself. But it certainly was my intention to, because I've always loved what Ray Dalio did around principles. And, I mean, for those of you who don't know, I mean, he's built this incredible business. And the way that he did it was his principles kept, every time he learned a lesson or made a mistake, he sort of created another principle. And then those principles are how he built not only his life, but his business. So I think it's a very important thing, but again, most of us, including me, just think about these things versus putting them in our heads, which is why I thought this was a valuable. So I'll take a picture of this and I'll share it on the WhatsApp group for everyone. But back to you, Ricky.
Thanks, Scott, as well.
We can't hear you now, dude. I think you're muted.
I was just saying, thanks, Scott. I appreciate the introduction. It's lovely meeting all of you. And yeah, hopefully we're going to learn something together today. Was this valuable for me to just listen in on where everyone's at? It sounds like you're all very much human and we're all on a similar journey. So it's good to be sharing that with you this morning. Yeah, as Scott spoke to it, I'm going to really try dive into as much detail as possible, specifically around multifamily. So I'm going to be touching a little bit less on why certain states are important, although Scott touched on it, so we can dive into those things. But my goal today is not necessarily to cover America and commercial real estate investing, but rather just to educate you on multifamily apartments specifically. And so, yeah, I'll guide you through the presentation as we do it. Please feel free to ask any questions. If you want to put your hand up during Zoom, and just let me know if there's any questions that you need addressed, and then we'll take it from there. So Scott's given a great introduction, so I'm going to skip over that and get into what we're talking about today. So first of all, we're going to be covering what is multifamily. And I've got a big screen on my left here. So if you see me looking to the left the whole time, I'm looking at our presentation. So what is multifamily? What are the multifamily property types and sectors and classes? Multifamily versus other commercial real estate sectors and how they differ, generically speaking, on a higher level. And then how to enhance returns in the value chain when doing multifamily transactions, as well as how to identify a good deal in multifamily. And then lastly, what I want to try to touch on, or not last, but generic last information, would be general partners and limited partnerships. And just giving you a breakdown of sort of how that's structured and exactly what you should look out for as an investor. Then we'll end off with the state of the market. Getting caught with your pants down is I think a good description of what's going on in the market today. The next 3 to 18 months is the best time to dollar cost average into the market, in my opinion, and I'll get into that. And then kind of just first principle thinking on where the market will be in 5 to 10 years from now. And I also thought it would be exciting if we have some time for me to actually open up some live deals that I'm working on. Nothing that's under contract, but just to give you an idea of sort of what's available in the market, everything from brand new product to older vintage deals, from a deal that's $1.5 million through to something that's $40 million, just to give you an idea of the different asset classes and sectors. Okay, so with that in mind, I'm curious, do most of you invest in real estate currently or not really? Yep, we got a thumbs up. I'm not sure. Have any of you ever invested in the US? Yep, some thumbs up. Cool. Scott, if there's anything going on in the chat, just let me know.
Graham just said he needs his camera off because he's at his daughter's house. But yeah, I'll keep you updated. Ricky, I think in general, that's the benefit of this mastermind, is that pretty much everyone is already an investor and invests in property. But it's the American diversification and different assets that is what's intriguing for everyone.
Perfect. So you all understand real estate, generally speaking. I'm going to cover some basics. Scott asked me to just keep it as basic as possible and then build on from that. So if there's anything that seems really basic, at the end of the day, this is real estate, not structured notes. So it is really basic. And it's really a case of doing enough and seeing enough deal volume to understand which deals have value to drive and which have already extracted all of the value out of them. So getting into multifamily. So multifamily is essentially considered in the States a commercial real estate asset class, even though it's all the tenants are residential. So as soon as you go above 5 or more units, then it's considered a commercial real estate class. And there's a number of different styles. So as you'll see here, you've got something called urban high-rise, which is the picture in the top right. You've got suburban garden. You've got mixed use, which would typically be like ground level would be retail, and above that would be apartments. And then you've got mid-rise, which would normally be 3 to 5 story walk-up or elevated service apartments. So these are typically the main categories. One that's coming more and more to the forefront is really the talk of town and industry at the moment is a product called build to rent. And that would be, that would essentially be, if you can imagine, like a local little estate. I don't know where in the world you live, but if you're in South Africa, you can imagine like a gated estate. And instead of everyone owning that single family home, so these are generally freestanding single family homes. Sometimes they can be townhomes or duplexes or something along those lines, but they're all individual and they're not stacked apartments, but the whole entire estate is purely rental stock. So that's a big distinguisher for multifamily compared to something else. So for example, you'll see urban high-rise buildings like this on the right, but it's not necessarily multifamily if it's not all rental stock. So often it'll be what in America they would refer to as a condominium, and that would just be like single hold free title. So that's the big distinguisher between multifamily housing and condo or single family housing, is that everything inside of that complex and area is purely rental housing. Okay. So some key features of multifamily apartments, as Scott had mentioned, is so historically these have actually had they've got the longest track record of the highest risk adjusted return. And that's really an important factor when considering different options and sectors inside of the real estate spectrum.
Ricky,
yeah.
can we just explain risk-adjusted return? Because I'm going to assume that not everyone is 100% in favor with what that means.
Yeah, sure. So let me let's see what happens if I click this link. Okay, so here's a lovely white paper. I assume you guys you've off my presentation onto this white paper, correct?
Yes, yeah,
cool.
yeah.
Okay, so I'll share these links with Scott. You can read these things in your own time because it's pretty long and comprehensive. But just to come to this table, so essentially what it means is over a certain holding period, your risk-adjusted return is it's your return versus the risk, and the risk is purely the way that they describe risk in any investment term really, or any investment world, is how much the price fluctuates. So how much the price goes up and down essentially of the asset that you're holding, of that investment. And if you have a look over here, you can see apartments have got a really high return and the lowest standard deviation. So across all the asset classes over a 10-year holding period, it had the highest mean return and it had the lowest standard deviation. And the standard deviation purely refers to that fluctuation in price. So a Sharpe ratio is just another ratio for taking the one and dividing it by the other. It's commonly used in the investment world. And so you can see it as the highest Sharpe ratio. And essentially that comes back to having the highest risk-adjusted return. So as an investor, you always want the least risky assets with the highest possible return. And across all the sectors in the US, apartments, as you can see here, has consistently outperformed the other asset classes, especially over the longer term. So coming back to the presentation, does that make sense to everyone so far?
Yep.
Yes. Okay, cool.
That's good.
Cool. So another important factor, and I mean, to some extent, a driver of these good returns, is that apartments have a lower cost of capital and wider availability of debt capital. So I'm going to get into this a little bit more later, but it's a really important factor because it drives a high level of liquidity in the market, and that's partially where the lower risk comes from. You can imagine if there's more willing buyers and willing sellers, prices fluctuate less. If there's less willing buyers and willing sellers, then prices, when they move, there's generally big price movements that take place. So this is by far the most liquid asset class in America, is actually multifamily apartments. And that's for a number of reasons. The financing components I'll get into a little bit later. Apartment properties also vary widely in terms of age, size, quality, location, and that creates a broad spectrum of strategies that you can get involved in when actually making these investments, which I'll also get into in a little bit more detail later. And another important component is that they're still underweighted in institutional real estate portfolios. So if you imagine large fund managers, pension capital, alternative hedge funds, Blackstone and the likes, these are massive allocators of funds. And over the years, they've steadily increased their allocation towards multifamily apartments. as a result of it having the highest risk-adjusted returns, as a result of the liquidity, and as it turns out, as a result of it being the best inflation hedge. And I'll get into why that's the case a little bit later. So the reason that that's an attractive thing is that more and more capital continues to flow into the space. And when more people are trying to buy limited stock of a certain item, that obviously pushes pricing up. Okay, so that's why that's an attractive thing. Coming back to the hedge on inflation, you'll see this next point is that apartments typically have a much larger spread of staggered leases. Okay, so that's a little bit different to the point that I was going to get to. But the reason staggered leases are really attractive is, you can imagine, if you buy an apartment block with 100 residents inside of it, that means you've got 100 separate leases to go through. That sounds like a lot of work, and it is a lot of work, and that's why we typically hire third-party management to take over that role. And there's normally people on payroll that actually run and manage that block. But more importantly, is it gives you a diversified stream of income. So if I bought a triple net building that only has a single tenant in it, that tenant might seem incredibly creditworthy, and they may be able to pay for the life of that term that you've got it on there. But I've seen in many cases very reputable companies eventually go dark on that site, which means that they try end their term in their lease, and then you're sitting with a purpose-built building that was specifically for running a pharmacy, for example, and it's not so easy to fill that 2,000 square meter space with someone new. It doesn't happen like this. Whereas in the apartment space, when you buy an apartment block, you've got 100 tenants that are inside there. You can stagger their leases out, which means that you can have 10 of them expiring in January, 10 of them expiring in February, 10 of them expiring in March, and so on and so forth. And that essentially mitigates your leasing risk quite drastically. And coming back to my point on the inflation hedge, is what's really nice is because most leases are only 12 months, you're able to reset it to the newest rate every 12 months. Whereas a lot of people now, for example, when inflation's around 5-6%, they're not getting that on their lease escalation, because if I signed a lease with a 10-year triple net tenant, in that lease I only get 2% for the next 10 years. So you can see how, ironically, a short-term lease is more attractive than a long-term lease in this sense, specifically if you're in a market where there's demand and there's a shortage of housing. Does that make sense to everyone so far? Yep. Cool. Okay, I'm talking a lot here, so just butt in if I'm missing anything or if it's getting a bit much. Apartments operate in a very favorable, transparent, market-driven, regulated environment. So they're very well regulated. There's lots of checks and balances that take place in every transaction. There's the lender's really your friend in most of these transactions. I wouldn't want to buy a building without a lender, because they're going to cross-check everything and cross the T's and dot the I's, and they're actually your partner in crime as far as regulation's concerned. And then the apartment market fundamentals are expected to remain extremely positive going forward. So just to give you an idea, there's a website called We Are Apartments, and they're consistently updating based on supply and demand shortfalls across America. And you can see here that the country, in order to come to some kind of balance between supply and demand, the country needs to build 4.3 million more apartments by 2035. So that's a pretty astronomical number, and that's partially the reason that rents have been driving so high over the last number of years. And this is largely a problem that was created through what we took advantage of with Scott in 2013, and that was, the last great financial crisis was mainly residential mortgage driven, and ever since then builders have been spooked. Building stopped, tools went down, and so we have this massive housing deficit despite development picking up rapidly over the last, let's say, 3 or 4 years. So this year will actually be the most newly built multifamily apartments coming into the market than ever in history, okay, which is quite scary to think, because the market is in a bit of disarray now. But as you can see, over the long term, if you've got a 4.3 million shortage of apartments, those will be absorbed fairly quickly. So certain cities, it's very important to, I'm giving you macro level. If you're diving into a sub-market, the micro is really all that counts. So for example, there may be oversupply in certain sub-markets and undersupply in other sub-markets. It's very important to be aware of that. I can't go into every single city on this call, but just to give you an idea of where it's at, they are at a deficit of 4.3 million apartments, and that obviously makes a big difference. So let me see, get this back into present mode. Okay. Apartments have shorter leases than other property types, allowing them to adjust to the market and changing environment more quickly. So I mentioned that already.
Just an interest, would you, and again, I'm putting you a little bit on the spot, but would you mind sharing this so that people have those links if they want to go and read the stuff?
Absolutely. Yeah. Not a problem.
Cool. Thanks. Sorry, I just, same for me as well, because I mean, these are some amazing resources.
Yeah, sure. Yeah, I can dive in here for hours, so I'm just going to keep it high level for now, but you can go in. Go in. I always encourage you to go cross-check everything yourself. Never believe anything anyone tells you. Don't outsource your thinking to anyone. So definitely don't outsource it to me. Go do your own research and come to your own conclusions. The data's out there. In terms of some of the different multifamily property types and sectors, this is a nice little table just giving us an idea of some of the other areas. So what I spoke to early on was more construction style when I referred to garden style apartments, mid-rise, high-rise, mixed use, and built to rent. Another way of describing these apartments is really looking at their types. So in the industry, we'll refer to something called core plus, value add, and opportunistic. Core would be something, for lack of a better description, a very established block in Manhattan, New York, and there's not much room for the rents to move. There's not much that you can do to improve the property, but it's on the best streets in town. It's almost 100% leased throughout the year, and you're paying a full price, but in theory, you're paying that price because there's less risk. So that would be my description of a core asset. And you can see over there, the source of investor returns is largely rental income, only with limited income growth. Okay, so there will be growth on the leases, growth will take place, but there's no way for us to add sort of immediate value. The next section after that, and sorry, importantly, the expected return on those assets is just 7 to 9%. That includes capital appreciation, by the way. So that's not you're not buying a 7 to 9 cap. That's you're probably buying around the market's in flux right now. I'll get to that later. But typically you're paying 4 to 5% on a deal like that, maybe as low as 3.5% in very unique circumstances. From a cap rate perspective, there will be some cash flow that comes out of the property. So in other words, rental income after servicing debt each year that'll make up part of that 7 to 9%, but very small part of that, and the rest will come from a sale later on. Okay, so that's hypothetically where those returns are coming from.
And we will come.
Plus,
we will come back to just talk about cap rate, because I guarantee most people don't know what that is, but we'll come back to that.
Yeah, so I've got a slide on that a little later.
Okay, sorry, Ricky, I'm going to be the translator if you don't mind.
yeah, no problem. Just interject whenever. So core plus is high quality assets that are stable and in good locations. Normally there's a little bit of value add. So the plus is the little bit of value add in order to achieve some kind of a high return. This would normally be in the format of doing some really minor renovations inside the property, or potentially it's just bad management and there's a large, what the industry calls loss to lease. So that would mean that if the rents across the road are $1,200 a month, and this property is only getting $1,100, even though it's very similar product, then theoretically you'd have a loss to lease of $100 a month. And so you would come in, you would try and manage it more efficiently and just raise the rents up to market level. That would be sort of a core plus opportunity. These are also generally in the best streets in town. They're a newer product and it looks great. The next market segment, and probably one of the largestly promoted online. You know, whenever you find some random syndicator online promoting multifamily apartments or talking about them, the biggest space to play in is value add. We typically did a lot of value add deals ourselves, not doing any of them right now, except for a little one we were awarded last night, but that's a much smaller deal that we're just doing as a family. But typically when we're syndicating these, we're not focusing on value add at this point in time. I'll get to that later, but for now, value add would just be 70s, 80s, 90s, 2000 build product that you're essentially looking to do a fairly large renovation on, either in the exterior or the interiors of the property, and that'll allow you to raise rents a good amount, like a pretty substantial amount, and that's essentially what helps you generate those higher returns. So you'll see there the expected return profile somewhere between 13 and 16% as an internal rate of return on these assets. They do carry a higher level of execution risk. So, for example, with supply chain issues over the last year or two, a lot of the pricing went up drastically. So, you thought you were going to redo flooring and paint the interiors and redo your appliances for $5,000 a unit, and surprise, surprise, it cost $10,000 a unit, and your budget was more than double. And so you have that level of execution risk in value add that you don't necessarily have in Core Plus, but theoretically the trade-off is that you're getting a higher return for taking that execution risk. Does that make sense to everyone?
Yep.
Cool. The last section is something called opportunistic. So coming back to a mutual friend of ours that Brendan mentioned, that Scott mentioned earlier, called Brendan. They do a lot of lesser value add, more maybe Core Plus, if you could call it that. But more recently, they've done some opportunistic projects too. And opportunistic would be something like, in their case, they're taking a hotel and they're converting that hotel into multifamily apartments. So hospitality's actually bounced back exceptionally well, but there were many hospitality operators that couldn't survive throughout COVID. And so they needed to sell in a distressed situation. Many operators were able to pick these hotels up at a much lower price basis. And hotel rooms are actually fairly big in America. Obviously depends on where you are, but typically speaking, if you go to a hotel in Europe versus America, the American floor size at least is much bigger. So they were able to convert these more into studio or single bedroom apartments, and that would be seen as an opportunistic play. Another opportunistic play could be ground up development, or could be a builder that's maybe developed halfway through and kind of ran out of money or something, and then you could step in and take over from there. So converting spaces to different uses and rezoning, and much bigger risk hypothetically, but again, should be a high return. And that's really the opportunistic space. So opportunistic would be best suited to someone that's got a high risk appetite, but is willing to take on the risk for high return, whereas Core Plus is maybe a sweeter spot for someone that doesn't have any appetite for or lower appetite for risk. Core, in my opinion, is a waste of time. and value add is another good mix of the two.
Ricky,
moving on to the next.
Ricky,
yeah.
I'm just going to steal the screen quickly. I just want to show people something.
Yeah.
I want to join people. So what Ricky's just taught you is it's a methodology around how you look at risk in commercial real estate, full stop. So whether you're looking at multifamily or industrial or office or retail or anything. So if you look at our platform, and this was a multifamily we did with that partner Infinity that Ricky, I think, was actually part of. But anyway, it doesn't matter. My point being is that he's just explained to you this risk category. So do you see how now this starts to become easy for you? Because you can go to a deal and you can see right quickly over here where it sits in that space. So again, I don't want to go into the detail about the platform, but I just wanted to show you how we tie the dots up so that what Ricky's explaining to you, again, you can start to learn this stuff. And that's why after time, it's actually really easy. You can go to the platform, you can go, oh, this is this. I understand this suits my criteria. Yes, no. But can you see how it empowers you as an investor?
Yeah. That's really valuable, Scott. Thank you. Those are great operators, by the way. Infinity Investments, they know their stuff. So moving on to the different sectors. So we've got Class A, Class B, Class C, and affordable apartments. So Class A would be, again, newer product, newer vintage. You'd all be happy to live there. Aside from the fact my wife and I lived in one for like a good year. And the biggest problem with apartments, in my opinion, is you got kids running above you and you got noise below you. But as far as amenities and the fit out's concerned, it's beautiful finishes. You normally have a nice pool. There's a gym there. There's like a dog park. There's a running track. There's all sorts of things in Class A properties that really make it desirable. And that's obviously geared towards the higher earning renter. Out of intersect, there's over 4 million people in America that earn more than $150,000 a year and choose to rent and stay in apartments. So just to clarify, there's a very large market segment in America that has more than enough money to buy a home, but they choose to rent because of lifestyle and because of the convenience that it provides. So that's Class A properties. Class B properties is similar to the project Scott just shared. So that's 80s, 90s built product, sometimes renovated, sometimes not renovated, but in fairly good condition. That would kind of be like your blue collar worker. They earn a good living and they just want somewhere to stay, and that's safe and secure. And that's what you'll find sort of in a Class B property. Class C, it starts getting more and more rough. We personally avoid Class C properties. So I think this is just important to explain on a return spectrum. So you would normally buy a Class A property at a much higher price than you buy a Class B property, and at a Class B property at a much higher price than you buy a Class C property. So what a lot of people do in the value add space, the goal, the dream, is to buy Class C, to renovate and to shift that community into what would be considered a Class B, because then you can sell it at a higher price after you've renovated and you've created better income streams. So I'll get into how property is valued on one or two of the slides later, but just as an overview, I think that's important to understand. So Class C properties we avoid. It gives a lot of headaches. Unfortunately, you're dealing with the lower end of most of the communities. So there's often issues and all sorts of things. When I was still working with Infinity, our one community that we managed, it was Class C. One of the residents literally drove into the management office with their car in a rage. I did some unit walks and they didn't, the heating and ventilation was like down. So they decided to just run their gas stovetops on full for the day. So like you have crazy things that go on in some of these communities. And for that purpose, I avoid Class C. There is, technically speaking, a Class D category too. Just stay away. If anyone comes to you with a Class D property, just don't even go there.
Can I just say, Ricky, sorry, just quickly. Yeah. So a bit of experience here for Ricky and I. We, Class C and D, there's even a thing called Section 8, which I don't know if that's D or E, but it's right at the bottom. It's basic government housing. And all I would say is from our own experience, because we've done it. The cheapest house I bought in America was $22,000. And it sounded incredible. The return was about a 15% in Memphis. It like sounded amazing. Okay. But what I've learned, whether it's in England and you're buying shitholes outside Birmingham and Manchester, or whether it's South Africa and you're buying shitholes in the center of town, or if it's America and you're buying shitholes, like my point being, it's the same thing all over the world. They look very good on paper, but there's a very different return between a paper return, so like what the presentation says, and a bank return, which is actually how much cash you get in your bank after you've paid for the bloody broken. Because like in Memphis, we kept having the air conditioning stolen, and just ongoing like issues that you don't even expect. So I just want to back up what Ricky's saying. It all looks good on paper, and often investors, particularly unsophisticated investors, are attracted by it looks very good on paper returns, but from my experience, it never pans out. Never, not once anywhere in the world yet.
Yeah. So you don't want to touch that. Okay, then there is this like affordable housing, which is what Scott was referring to with section 8. Not all of those are bad, but you really got to do your due diligence. So it needs to be well operated. There needs to be management that's very experienced with that. Tenant vetting needs to be great. And then sometimes you'll have people that come in on government vouchers that are good people, but it's far and few in between. And so you need a really strong management team to be on top of that. I would never recommend that as a starting point. So moving on. Okay, multifamily versus other commercial real estate sectors. Okay, so just I'm sure all of you are familiar with properties. You see them all the time. But basically retail, office, industrial, multifamily would be your main different sectors. There are subsectors inside of all of that. So medical would fall under medical office. Sometimes it's medical retail, depending on what that looks like. On the industrial side, there's plenty of different types of industrial. There's different types of office. And you can see some other unique asset classes is data centers, medical research, flex warehouses, which would be like a sub-department of industrial and office. And then we've got another massive thing in America that we're actually looking into quite a bit is RV and boat storage or parks. So that's a very big sector. There's mobile home parks, which you could say is a derivative of multifamily housing. And then there's self-storage and there's student accommodation. All of these are great. They've all got their pros and their cons. But I'm going to just specifically touch on some of the differences between multifamily and most of the other commercial real estate sectors, high level over here. So the tenant type is obviously the one's residential, the other's commercial, with the exception of, if you're doing self-storage, then that's generally a residential tenant most of the time. Same thing with RV parks, would also be considered more of a residential tenant that would be signing on the lease. But far and wide speaking, most of the other sectors are commercial tenants. Lease terms are shorter terms versus longer terms. Again, self-storage would be an exception here, so you can almost throw that in the side of multifamily. Those you can lease on a month-to-month basis. Maintenance and management, the downside of multifamily is it is a lot more intensive. You are dealing with, I'm trying to think, toilets, termites, and something else that I can't remember, but there's the triple T's that you're dealing with all the time. So it is a lot more intensive dealing with people.
Toilets, termites,
and tenants, yeah. Hopefully you have the tenant part, otherwise you've got real issues. If you just got termites and toilets. So yeah, you're dealing with that on a consistent basis. Obviously, consumers are difficult. I'm one of them. I want my apartment to be in great shape. If there's a leaking faucet, I'm calling the management team. That's the way that it works in America. I'm not fixing it myself. So it is definitely a more intensive process. And that's why we personally like to use third-party management that does that for us on the ground there. Whereas in most other commercial real estate sectors, it's a lot less hands-on. It's easier maintenance and management and less kind of wear and tear. And a lot of the leases would be a triple net lease or something to that extent, where if it gets broken, then the tenant will fix it as a commercial tenant. So you'll see cap rates. We'll come back to that later, Scott alluded to, but multifamily apartments generally trade at lower cap rates than other commercial real estate sectors. And that should tell you something. So what that tells you is that it's seen as a lower risk asset class and a more attractive and liquid asset class, because more people are prepared to pay a higher price for multifamily apartments than there are for other commercial real estate sectors. A large test of time was obviously COVID, which was a very unique situation. But as we saw during COVID, apartments, people didn't leave their homes. So, at the end of the day, if you run out of money, the last thing that you want to do is stop paying your rent and get evicted. Specifically in America, coming back to the states that Scott mentioned, you have blue states and you have red states. Not to get overly political, but you want to invest ideally in red states because the evictions moratoriums are normally strong and in place, and you're able to overcome those issues and evict the tenant fairly quickly if they present any issues. Whereas if you were in New York, like Scott alluded to earlier, if the resident wants to be difficult, you got the same problem that you have in South Africa. It can take you up to 12 months to get the tenants out. And at the end of the day, you're the criminal for kicking them out after they've broken the place and haven't paid their rent for 12 months. So in order to avoid that, I highly recommend investing in red states. But my point being, through COVID, is many of the other asset classes and sectors took an absolute hiding, but tenants continue to pay rent throughout COVID in our sector, in multifamily apartments specifically. And as a result, cap rates continue to compress. So they went from 6% to below 4% during and after COVID. And now with interest rates doubling recently, they've gone back up to somewhere around, let's call it 5. But just to give you an idea from a resiliency perspective, this asset class bodes extremely well. And if you come back to just thinking out of a logical sense, the last thing you want to give up in times of distress or instability is your home and where you live, particularly for people that are maybe in Class B apartments and the next step is Class C, and then you're in a whole different kind of community that you don't want to be in. So I think that's also important to keep in mind, and that's one of the reasons that they have lower cap rates. When it comes to financing,
I think also, Ricky, something that I learned in the last crash was that it's also resilient during hard times for the reason you just mentioned. So in hard times, people, they won't necessarily buy expensive houses, but they still need a place to live. So people often downgrade, which actually, it makes this asset class more attractive in tough economic conditions versus, positive economic conditions, if that makes sense.
Yeah. So right now we're in a mix. I think trying to think who I can't remember Mr. Ferreira's first name, but I think he mentioned talking about the different markets, and you read things on one side, the job market's as strong as it's ever been, and on the other side, they're predicting a massive crash in 2 months. So the multifamily apartments is in a similar scenario with fundamentals. Well, really the whole commercial real estate industry. And I'll get into that a bit later, but it comes back to what you're saying now, Scott. So in terms of financing, it's a lot easier to finance multifamily apartments. I don't know if you've heard of Fannie Mae or Freddie Mac. They're the largest government-backed lenders in America. Partially part of the reason for the last GFC, but they've learned from their lessons. Government actually took over there and is doing a pretty good job considering it's government. And so they have a mandate to always put out a certain amount of capital every single year, irrespective of what's happening in financial markets, into this industry for housing specifically. So most other real estate sectors, you'll get your loan amortized over, say, 20 to 25 years, or anywhere between 15 and 25 years for other commercial real estate sectors. On multifamily apartments, you can literally get some programs that will amortize your loan over 35 years. So you can imagine what that does to your monthly installments and how much it supports the cash flow and kind of keeps the industry alive and floating. So you'll get your lowest interest rates typically in multifamily with the most favorable terms. And there are endless amounts of lenders, from banks to CMBS to pension funds, insurance funds, and then the government-backed agencies that I was referring to. So that's a really nice luxury that many of the other commercial real estate sectors don't have access to. The next thing is depreciation. So as far as the assets are concerned, multifamily is depreciated over 27.5 years as opposed to 39 years. So many of the other commercial real estate sectors are over 39 years. This is over 27.5 years. And what that is essentially is it gives you the opportunity to write off a paper loss against your personal income in America at a faster rate than what you could in any of the other sectors. So it's very good for sheltering taxes in the United States, the multifamily asset class. Is there any questions around this before I move on to the next slide? Everyone good? Great.
Yep.
Okay, so the question is, how do you enhance returns in the multifamily value chain? Okay, so coming back to cap rates and NOI. So at the end of the day, your cap rate is just your net operating income, which is your income after all your expenses, not including your bond, not including servicing of bond costs, anything like that, divided by your purchase price. If you're more of like an investor and shares person, think of this as a price to earnings ratio in reverse. So your earnings divided by your price rather than the other way around. And so essentially what that gives you is something called your cap rate. So as an example here, if the property was generating income after expenses of $100,000 a year and the market valued that property at a 5 cap, then the value of that property would be $2 million. Okay, is everyone following me so far? So the way to increase...
Sorry, Ricky, just to be two things I think that are important. And apologies, people, if I'm jumping in and going to simplicity, but I'm doing it on purpose because I'm going to assume that, I didn't know this stuff either. Was that firstly, cap rate stands for capitalization rate. So just in case you see those two things. Yeah. And secondly, what Ricky's doing, if you took a calculator there, you're taking 100,000 and you're dividing it by 5%, which is how you get to 2 million. So I know I'm giving you probably for some obvious maths, but that's the way that the way it calculates. So it's a 5% return, the cap rate is 5%, and you're getting $100,000 in income, and you divide the two, and that's how you get the value of 2 million. Does it make sense? Sorry, this is such an important principle, not just for multifamily, but for commercial real estate, full stop, because it's how you value commercial real estate.
Yeah, that's perfect. Thanks, Scott. And so what you'll notice is that the cap rate is driven by the market. So to a large extent, that's outside of your control. You can kind of see where trends are going. You can make some assumptions based on institutional capital entering the market, based on a number of things taking place. But the reality is that that number is somewhat outside of your control when you enter into a business plan. And the number that is a little bit more inside of your control is the net operating income. So that's where we really look to try and drive as much value as possible as operators when buying these assets. And your net operating income is literally just your gross or your total collected income. So we have rental income, and then we normally have all sorts of additional fees, whether that's pullbacks for utilities, application fees, pet rent, sewer and trash income for taking out the trash, and there's a number of different services depending on the property that you can offer in addition to just rent, or incomes that you can generate in addition to just rent. But essentially your net operating income is just all the income you collect from your tenants in their various forms, minus all the expenses that it costs to run that block. So that's how we try and generate value, is through making that more efficient. So we can either increase rents or we can reduce expenses. And that's really what every single private equity real estate fund is trying to do on their deals, is figure out ways to increase the rent and to reduce the expenses, and then to sell back into the market, hopefully at the same or lower cap rate. So yeah, as you can see, just to give you a rough idea. So if we were to increase the net operating income from $100,000 to $120,000 through either better leasing or reducing expenses, or through renovating, although I haven't taken into account in this case renovation costs to keep it simple, okay, then at a 5 cap, we would have increased the value from $2 million to $2.4 million. So you can see there's a $400,000 increase from when you bought it if you can increase the income by 20%, right? So that makes sense, because 400 over 2 is 20%. So you're increasing income 20%, which means you're increasing the value of the property 20%. Where it gets a little bit more exciting, I mean, 20% is great, but when it gets a little bit more exciting is if you're borrowing 70% for the transaction. So the bank's borrowing you 70%, your net operating income is able to service the interest on your loan. So let's just assume you're getting no cash flow, but you've got enough income to cover your bond. Okay, then that 20% of that $400,000 suddenly becomes a much higher return, because you only put down $800,000 of your own money. You're borrowing 70 from the bank. So now you're in theory making a 50% return with that little bit of extra leverage on the asset. And that's really the golden nugget for real estate. Now, it sounds a lot simpler in this explanation than what it is in real life. There's also plenty of fees involved that drive that down. And normally you wouldn't be able to just buy a building and raise the rent without doing any renovation work or spending CapEx. So spending, when I say CapEx, is money for capital expenditure on the building to improve it. So typically, your returns wouldn't just come out this high, but to give you a generic high-level idea of exactly what everyone tries to do to generate a higher return than just the rental income, this is pretty much it and what it looks like. Does anyone have any questions around this? Does this make sense?
Ricky, there's a question here. What are the biggest drivers of cap rates? Vilko's asking, what is the biggest drivers of cap rates, and why would certain properties be a 5% versus 7%?
Yeah, great. So coming back to the different sectors and classes. So class A versus core. So class A and core, I'm going to just put them together because they kind of fit in a similar realm because they're both more desirable. So let's just describe it like that for now. The highly desirable product that's always fully leased and seems to always have rental growth will be priced typically at a lower cap rate because they're seen to have less risk. So the market will price them at a lower cap rate, which means you're going to pay more for them, if that makes sense.
So let's just use, I'm going to be completely facetious, but I'm just going to use an area everyone in the world will know. A beautiful building in Manhattan on 5th Avenue, like literally, like, you know what I mean? Completely desirable. Everyone wants it. It's probably A++ to be fair, but you get my point. Like, you know, that's, it's well-known, good location, et cetera, et cetera.
Yeah. So that would be trading at, let's say, below 5 cap. For those of you that watch The Office, if you owned an office building in Scranton, or just some random town in America, you'd be paying a 7 cap. So that's kind of the difference. It really depends on the age, the vintage, and the demand for that specific asset.
I would actually answer it, Ricky. I'd answer it as simple as Economics 101. Literally, if I remember one thing from Economics 101, it's supply and demand. It's so to answer your question, Pulko, what drives cap rate up or down is supply and demand. If there's less demand, the cap rate's higher. If there's more demand, the cap rate's lower.
Yeah, so to take that a level further, so that kind of explains the difference in cap rates between the asset classes and sectors. What drives all cap rates as a whole is highly debated. So most people would say it's a function of, or a lot of people would say it's a function of interest rates. Other people would say it's a function of the weight of capital available in the market at a given point in time. So it's basically a different way of saying supply and demand on the second case. Most people in America are used to buying with positive leverage. So they've generally, in the last 15, 20 years in America, have had the luxury of buying with what they would call is positive leverage, which means that if you borrow from a bank, the cost of borrowing that capital is less than the return you'll be earning in rental income from the property. Okay. In South Africa, we don't normally have that luxury. So we normally buy at, say, a 9 cap, but we pay 11% in interest rates. And we wait 2 or 3 years, we need to pay in towards the bond out of our pocket. And then eventually the rental income catches up because we have a lot of inflation escalations in South Africa in our leases. Okay, so that's kind of the style in South Africa. But in America, they have had some of that in the 70s when inflation was out of control. And I've got lots of great reports on this if you want to dive into it, as to what happens in a case of high inflation like America's in right now. But the market's a little bit confused because right now cap rates are lower than what interest rates are. And so they don't have that luxury. And there's one side of the fence that says, well, that means cap rates is going to have to go up until interest rates catch up with, until cap rates catch up with where interest rates are so that they can get positive leverage again. And another side of the fence says cap rates have nothing to do with interest rates. They have to do with how much capital is chasing that asset at any given point in time. And so it's quite a heavily debated topic. But for the sake of simplicity, I'm just going to say supply and demand, like Scott mentioned, and I'll happily share some like really cool data on the last, since the 70s, what's happened with each interest rate cycle and how that's affected cap rates, and what's happened in the market as a result.
Can I say something, Eric?
Ricky, if I may ask.
After you, Derek.
Thanks. If I may ask a question, from what I'm hearing, that there shouldn't be a huge amount of volatility. And then what would the driver of the volatility be? You know what I mean? So it's supply and demand is not something that changes overnight, and would cause a lot of volatility in it.
Yeah. So I'm gonna get into that a little bit more later when I come to state of the market. But typically speaking, like actual supply and demand of the asset class will drive it to some extent. So how many people are moving into that city, that area, that town, versus how much new supply is being built, new construction coming in there, that would to some extent be a driver. And then the other side is largely because real estate is so heavily driven by leverage, the fluctuations in interest rates can affect demand in the short term. So that's kind of where the market's at today, because you used to borrow less than 12 months ago, I would have gotten an interest rate around 3%. Today, my quotes are coming in at like 6.25%. So imagine during COVID, I think in South Africa, we're around 8% or something like that. Imagine you were at 16 today. The market would take a bit of a hiding, specifically in commercial real estate where it's less emotionally driven.
Absolutely. Yeah. Thanks.
I just want to say something
Sure.
quickly because I'd be surprised if a few people are not feeling overwhelmed by all this stuff. Okay. Just reminding you that always remember that there's two simple principles that I've learned over the last 25 years. It's about getting the right information and the right partners. So you don't have to know everything that's in Ricky's head. Okay. Let Ricky be the expert in helping us figure it out. But as a partner, he comes to us and he says, this sector is doing well. This is the research. This is what's happening in the interest rate cycle. This is the cap rate, and allows us to invest with partners that are already specialists. Last month we did Cashbox. Don't ask Ricky to be an expert in structured notes. Don't ask Chad Pope to be an expert in multifamily. So again, I'm wanting you to learn the stuff, but you don't have to have the level of knowledge that everyone has in each deep sector, because you can't. That's diversification doesn't work like that. So sorry, just a caveat to that.
Yeah, no, I think that's great. And if anyone has any more questions, or you have projects from other people that you'd like me to briefly look at that you're considering investing in, just send them to Scott. You can send them to me. I'm happy to take a look at it and assist where I can. Always curious to see what's happening in the market and what assumptions people are making, because all of these business plans, if you're not holding for life, are very sensitive to what the exit cap rate would be when you sell, as you can see through this illustration. And so in today's market, it's very interesting to see.
And every financial planner and salesman will tell you that you're buying at a 9 cap and you're going to sell at a 5 and you're all going to be billionaires, because the easiest way to make money is on a spreadsheet.
Yeah. And many people did that from 2015 to 2021 or end of 2022. And so that was just lucky, because your business model should never evolve around cap rate compression. You should actually allow for some cap rate expansion during the whole period, because you're buying a building that's 5 years newer than what you're selling if you're holding for 5 years, if that makes sense. So, whereas a lot of people do the reverse. Anyway, common mistakes when it comes to cap rates is people buy on a cap rate, not thinking about cash flow. So they think that the cap rate is going to equal cash flow, but like Scott said, on a spreadsheet it looks great, and then in reality you don't have cash flow because of what's going on in your capital stack, which means it might be made up of, still you got to service your debt. There might be other lenders on the property that you're unaware of that get paid ahead of you. And then other important things when you're buying older buildings is air cons break, windows need to get replaced, refrigerators need to get replaced, like things happen that takes up all of that excess rental income that you thought you were making. So those are important things to be aware of. A lot of people also forget that when you place a tenant, there's a leasing commission, so they don't factor that in. And so your cap rate isn't necessarily everything. You want to always make sure what happens below the net operating income is also accounted for, to make sure that you get paid. And that's maybe going into a bit too much detail for this call, but something I would happily look at for you if you're pursuing a project.
But again, Ricky, sorry, I'm going to keep butting in here. Back to partners.
Yeah.
Because again, on a spreadsheet, it all looks good, but who the hell's actually going to go and do the work on the ground is critically important.
Yeah, absolutely. So as I mentioned, the value add strategy is the most common, widely used amongst private equity companies. That's what the bulk of people are doing to generate the highest returns. They're trying to buy 70s, 80s, 90s product, do a really nice renovation on the inside and the outside. And maybe the rent goes from $1,000 a month to $1,350 a month. And as a result, you're increasing the income, 35%. So you could imagine unleveraged, the value of that property hypothetically goes up 35%. The reality is you're spending some money to do the renovation on a per unit basis. So the actual return is probably closer to 25, but like you kind of get the idea of how people create value in the space. And what you need to look for that when you're doing it is you need to, first of all, make sure that the rental income that you want to charge after your renovation is supported by the median household income. So you see that in the top right of here. Okay. And there's a few other rent support indicators that we'll look at too. But just high level, those are one of the things you want to be aware of. You need to look at what the other supply options are for tenants in that market. So if you're taking a 70s building and you're spending $20,000 a unit to make it look beautiful, and you're hoping to get $1,350 a month in rent, but there's brand new Class A apartments across the road renting for $1,350 a unit, it doesn't matter how much you spend, you're not going to charge the same amount as brand new apartments that have just been built. It's just close to impossible to happen. So it's important to understand what's going on in that market and to know what you're basing your rent assumption post-renovation on. So ideally, you want to be at least $200 below anything that's been built new. And if you're really lucky, you've got a property right across the road that's just renovated, and you can see they're getting $1,350 for their units or $1,250, and then you know that you can definitely hit those numbers. So it's really important to look at what's going on in that submarket, get an understanding of what amenities they have, what they're charging for. Some apartment blocks bill back for all the utilities, others don't. Then you need to factor that into their rental numbers. So it might look like their rents are high, but they're actually not charging back for electricity, water and sewer, trash, pest control, all of those things. And you were planning on billing back that amount plus getting that high rent. It's not going to happen. So there's a lot of little assumptions that go into these things. So as you can see, multifamily apartments or any real estate is really simple. There's no rocket science here, but it's just an understanding of clearly knowing what's going on in that market and getting down to the underlying assumptions and making sure that you're like for like and not mismatching things. So renovation costs versus the rental premiums, we touched on that. And then like Scott said, an effective execution team is vital. Other ways to improve enhance returns in multifamily with the value chain would be to improve operational efficiency. I'm just going to kind of skip over some of these because I know that we've limited on time here. So I'm just going to read the top ones. I'll send you the presentation. You can go through everything your own time, but logically it's to improve operational efficiency. It would be to have some strategic partnerships, to innovate amenities and services, so to offer something unique to residents that they really like, to invest in technology. Out of interest sake, AI is going wild at the moment. I hope you're paying a lot of attention and are all over ChatGPT's playground and are diving into these things like crazy, because you're either going to get left behind or you're going to be miles ahead. And the same thing's happening in our space. This is a rental collection agency that basically has text conversation with tenants. The moment that they miss their payment date, it'll start a text conversation and give them a gateway to be able to pay. and it'll seem like a human's talking to them, asking them, hey, we noticed you missed your rent. When will you be able to pay? What's going on? These are some of our options. Just remember that if you haven't paid your rent by date XYZ, then we're going to have to pursue legal action. So these little steps and things happening in technology help like bad debt collections go up drastically. And this is just an example of a use case of what's going on in the technology sphere in our space right now. Then increasing market penetration and building scale in a market is also really important, because then you can allocate costs across multiple properties. So your payroll, you can imagine if you, we own a 34-unit apartment block in Columbia, South Carolina. That's quite small. So we can't have someone that's dedicated on our payroll just to that apartment block. But if we pair up with a management company that also manages a few other apartments blocks in that area, then collectively we can assign a portion of the payroll towards that maintenance tech that can come in and do the work. And then we don't need to pay a third-party contractor to come in that bills us at a much higher rate. So those are little things that I'm referring to over there when it makes sense to try build scale inside of a market. Another example of that would be on the leasing side. If I've got 34 units, but I don't have any studios in my apartment complex, and someone comes to our apartment block because they saw a marketing campaign, but we can't entertain them, it's great if I have another block that owns studios, then through the marketing spend that I had for the one, I can take that tenant and place it in the other. So building out scale is really important to be competitive. Okay, how to identify a good deal in multifamily. So there's a couple of things here. Location is extremely important. That comes down to really multifamily is driven by two things. It's job growth. Well, it's really one thing, it's job growth. So are there jobs growing in that area, and is there population growth? But population growth is largely driven by job growth in America. Americans just move everywhere all the time for jobs. It's ridiculous. So it's quite rare to find American family all in the same city because they move all over for jobs all of the time. And so you essentially want to be in submarkets that are creating employment opportunities consistently. And luckily we have access to data that can support that for each submarket that we invest in. And so that's a really important component. I also like to be in areas that have a household income above $65,000 or more. Because just from experience, and I know if something really goes wrong and I want to move into that apartment block to make sure I can fix it and get it right, I want it to be a nice place with people that I can relate to and spend time with. So that's a personal preference, but coming down to location, you really just want to make sure that there's employment growth. Property condition assessment. We were under contract on a deal in Charleston, South Carolina, that we had to terminate recently after going through an inspection. So it is incredibly important to hire an inspector whenever you're buying a multifamily apartment block. We couldn't see it. And then we found out through the inspector that some of the flooring was actually collapsing underneath. So in America, they have some of the construction styles have crawl space underneath it, which means that there's like a gap between the floor and, between the apartment floor and between the actual floor. And as a result, some of the flooring was seeping, and they picked up on that. They picked up on all the windows that needed replacing. And so the seller didn't want to give us a credit, and we ended up needing to cancel the deal because the cost associated with getting that repaired was just too high. The broker said everything was fine. I looked the seller in the eye. He told me everything's fine. Don't worry. There's nothing that you need to be aware of. And luckily I hired a third-party inspector. They do a great job of this. They know things that I don't know, and they went in there and highlighted that concern to me. And then when I addressed it with them, all the skeletons came out the closet, and the existing owner had actually sued the prior owner for selling him the apartment complex with collapsing flooring. He won the settlement in court, took the money, didn't fix the flooring, tried to pass the problem on to the next buyer, which would have been me. So property condition and inspection reports are vitally important. Can't stress it enough. There are plenty of crooks, and in hard times, there's even more crooks. So I'd highly recommend spending the extra money.
And also, Ricky, there's a famous saying in Australia and America, the fastest way to be a millionaire is to arrive with $5 million.
Yeah, yeah.
So, like, my point being
True.
is that they see you coming from a long way away when you're from overseas.
Yeah, absolutely. Then on the rental income side, never believe a broker's pro forma. Always verify all the income. If you're looking at investing in someone else's project, make sure there's not a big disparity or big difference between what they're saying you're going to earn in year one versus what the properties earn over the last 12 months, unless they've got a very good reason. And you can actually verify that reason based on what I said earlier, which is there are other comparative properties across the road generating the exact same amount of rent, or some kind of reduction in expenses that's very real. Don't assume things will just change, because they don't. So expenses are very important to verify. Rental income is very important to verify. We always do something called a lease audit, which is very common practice. So the third-party management company that will take over afterwards will help you go through every single lease. You verify that the income's real, that it's coming in, that they're paying. Lots of crooked sellers will do what they call lease stacking just before selling the property. So they will literally just place any tenants in there with bad credit at the highest rate that they can get, because then it seems like that's the new market rate. And so you buy it thinking you can move all the leases to that price, but that guy ends up not paying his rent, being a terrible resident, and you get stuck with all of the negatives of that. So there are quite a lot of things to look out for and to be aware of. Financing, many deals sometimes look really great on paper, so that's just something to be aware of. So someone's internal rate of return might look like 20%, but it's because they're borrowing insane amounts of debt and they're stacking up what's called mezzanine debt. So you've got your primary lender, which for simplicity's sake, let's say that's the bank, and then you've got someone borrowing in between, and then you're the little equity piece at the top, and the returns look really high, but you only get paid after the bank and after that mezzanine lender. And so the risk profile of that property is substantially higher than if there was only a primary lender. And so I've seen that time and time again, and lots of people got caught with their pants down, which we'll get into soon, in the last 12 months in this exact situation. Market trends are important. Sorry, I'm like kind of bending around my first screen to look at the second screen. And then having an exit strategy is important. Okay, general partners and limited partners in a partnership. So most of you, when you make an investment, you'll invest into what's called the GP-LP structure, very commonly used in the US. And your general partner would be like myself. If I was buying the property and then I was raising investor capital, me and my team in America would be seen as the general partnership. We are responsible for essentially managing and operating a property on a daily basis. We take liability for the debt and sign on the debt, and we typically contribute, say, 5 to 10% of the total equity required. And then a limited partner would be where you would typically invest or participate in a structure like this, and you would have no liability to debt, or you'd have completely limited liability. There'd be no personal liability. You wouldn't have any control over the property and over the day-to-day operations. And then you would typically participate with 85 to 95% of the equity. So Scott's platform and what they've built would help a general partner like myself or Infinity or every other person that does this essentially raise capital from limited partners. All right, so what's in it for general partners versus limited partners, just so that you understand. So we go in with financial risk being the same. So, and that's something to check. Don't assume that, but it should be that everyone goes in with the same financial risk. But to make it attractive for us as a sponsor and an operator for putting this whole thing together and for signing on the debt, we normally want a different financial reward. So there will be a disproportionate reward that goes to the general partner versus the limited partner. And that's how and why they will typically take limited partners on board for the investment. And the reality is, at the end of the day, the logic is that, yeah. Do you want to ask a question?
No, I think.
Oh, okay. He's got to go. So the reality is over here that the idea is that you make the pie bigger before you have the disproportionate split. So most of these deals will be structured in such a way that the investor first needs to get their capital back. Okay, so if you invest $100,000, we'll first need to give you the $100,000 back, and then we'll need to pay you what's called a preferred hurdle return. Okay, and only after that, then does the disproportionate return come into play. So the preferred hurdle returns can be anywhere from 5 to 10%, depending on the project and the operator, and anything above 5%. So I first need to give you $105,000 back in year one before I can take any additional return on your money. And this structure kind of allows for a disproportionate reward, but only if we first make the pie bigger for everyone. And that's how these deals are structured. Does that make sense to everyone?
I mean, I think the simple terms is the word is alignment, because you're only making money after the investors made money.
Correct. After you've gotten a certain hurdle. And that hurdle normally changes slightly depending on what's available in other markets, what would be available if you put the money in the bank, what would be available if you borrowed it as a loan. You know, that's kind of what affects the hurdle to a large degree. Okay, fees a sponsor can generate. So if they're doing a development, they might charge a development fee. They might charge leasing fees, acquisition fees, asset management fees, property management, disposition fees. There's lots of fees that a sponsor can charge to generate revenue. So it's important when you go into something to try and be aware of what those fees are. Make sure that they're market related. It does cost money to run this business. So you know, I charge fees. I highly encourage any sponsor to charge fees because this is what we do day in, day out and do for a living. And as an example, that little deal in Charleston, South Carolina that I didn't end up pursuing because the inspection came back poorly, we probably lost about $40,000 in that on pursuit costs. So, you know, people don't work for free, and then you lose that deal because it's not in the best interest of ourselves and our investors. And you go on to the next deal, and that's why we charge some upfront fees to stay afloat. But coming back to alignment, you want to make sure that the sponsor always makes the majority of his money, at least double what he makes in upfront fees on the back end if the property performs. You never ever want to see your sponsor only making the majority of their fees upfront and very little on the back end. So you always want to try to tailor it aligned, like Scott was mentioning. Okay, things to look out for as a limited partner investor. So this is a little bit more technical than what I maybe like, but it's really important because people get a little bit abused in this sense. So you need to get very clear on what your waterfall says. So your waterfall is essentially the order in which everyone gets paid as cash comes back into the business. And essentially what that means is who gets paid first. You want to make sure that as the investor, you get paid back your capital first, and then you get your preferred return. And then after that preferred return, profits are split. So it's really important for you to look into that. And then on the preferred return side, it's also important to know whether that's cumulative each year or non-cumulative, which means that if they didn't achieve it in the first year, do they need to catch it up in the second year plus the second year's return before they can start getting profit share? Or will that just lapse into the next year? So all of these things are outlined in what's called an operating agreement between the general partner and the limited partner. And I'm sorry, I'm getting technical, but it is really important for you as an investor to pay attention to that, to read it, reread it, and read it again and ask questions. Ideally, the best practice would be to ask them to actually do a diagram for you to do a diagram on how exact amounts would flow when the sale takes place to make it as clear as possible. The other thing that you want to check in the language is it, are the distributions written as a return on capital or a return of capital? So that also makes a difference to your total end return, because if it's a return, if they're treating distributions as a return of capital, then it means that whatever's remaining, that preferred return will only be calculated on what's remaining, not on what the original investment amount was. You also want to make sure that the GP equity, so the general partner's equity, that's the people that are putting in 5 to 10% of their own money, you want to make sure that it really is their own money. A lot of them, it's not their own money. So you want to make sure that that contribution is their own money, and you want to make sure that at worst, it's treated the exact same as your money, so they lose when you lose. At best, you want to try to position it in such a way that they actually lose first. So if you can get this right, it's really nice that if a project doesn't go according to plan, that the general partner's equity that gets contributed takes the first loss before you as a limited partner take the loss. So that also helps mitigate risk to a certain extent. It makes sure that they're on their toes and that their disproportionate reward is matched with disproportionate loss. Not many people do that. It's quite difficult to achieve, but it's not impossible. So I know Infinity does that with some of the people they partner with, which is great. Last two things over here that I want to mention on this point is see what mechanisms are available to you or in your control if things don't go according to plan. So again, this will be outlined in the operating agreement. As far as possible, limited partners are meant to be passive. You should just get your quarterly, monthly, annual distribution, and you should get a little update letter that tells you things are going according to plan or things are not going according to plan. Here's how we're going to fix it. And you should be completely passive, not having anything to do. But in the situation where things don't go according to plan, and God willing, it'll never happen to you, but if it does happen, you want to make sure in the operating agreement there's a clear outline on how they can be dealt with and how the general partnership can possibly be fired from an asset management role, and a third-party asset management company could be hired to come in and replace them. So these are little nuances that is quite technical and maybe a little bit over your head at this point in time, because if you're not living and breathing it every day, it can be a bit overwhelming. But these are things that, theoretically, Scott and the Wealth Migrate platform and the sponsors that they're partnering with have considered and are kind of doing on your behalf.
Well, sorry, Ricky, I just want to be very clear there, because there's two things that are important. The first one is like that return on capital, return of capital. That's the first time I've ever heard that. I've been doing this 25 years. So again, back to let's call it Wealth Migrate. Our job is not to try and analyze a deal and go into the level of detail of whether it's return on capital or return of capital. I want to be very clear on that. Our job is to find Ricky that knows the difference between those two things. Does that make sense?
Yeah.
Our job is to find partners that know what they're talking about, not to know everything. Because there's no ways that I know what Ricky knows about multifamily, I or any team member for that matter, or Cashbox, etc. And I just want to keep reinforcing that, because we're not the experts in everything and can't be. But what we need to do is find trusted partners that are the experts in these spaces. And again, I'm just reinforcing this, Ricky, because everyone on this call, including me, doesn't need to know everything that you have just explained.
Yeah. Yeah, agreed. That's where due diligence on the partners are so important. And to be fair, a lot of people in the industry don't even know this or see it. But I've been quite fortunate to be on both sides of the fence in the sense of working with yourself and Infinity, where you're mainly raising capital on behalf of general partners, and then I've also worked for general partners themselves, and now I've done one or two of my own deals. So I've had a wide spectrum of these
and we've seen it go wrong. So we were involved in multi-family deals where they saw us coming, and as Ricky said, with this mezz debt waterfall stack, money was made in the deal, but we lost in the queue and ended up, barely we got our capital back, but we barely made a return, and the general partner made the money. Yeah,
the general partner and the guy in between you. So, I think there was part of the general partner in the end, so that was not a great outcome, but Yeah, so I mean that Scott just hit the next point nail on the head over there. So I'm going to skip over that. All right. So what is the state of the market now? Well, a lot of people are getting caught with their pants down. So I'm in this market every single day. To bring it into some context, let me see if I can just open up Monday.com here for you. So I'm in this market every day. Like, these are deals that we're underwriting now. These are deals that I'm preparing letters of intent on. These are deals that we've killed in the recent few months. These are deals that we got outbid and lost on. So we're literally doing this. Like, this is all that I do all day long, every day, pretty much. It's just what I do. So we're in the market every day. So I'm just telling you that to be able to update you on some of the things that are going on. I think that makes it a little bit more interesting. So getting caught with your pants down is pretty much what's happened in the market today. People kept buying at lower and lower cap rates because interest rates were going lower and lower and lower. And I find it ironic today because the whole market is waiting for the smart money to buy back into the market. And the smart money would be some of your biggest private equity funds in the world, like your Blackstone, as an example, would be one of those. Carlyle Group, Blackstone, there's a whole number of them. But basically, the whole industry is waiting for these guys to come back into the market. And when they come back in, they think it's safe to move in because they're the smart money. But at the same time, the smart money are the people that led us all the way to sub 3 caps. They were buying deals at the highest pricing available. You know, the smart money was just a Silicon Valley Bank. and they bought treasuries and were long on treasuries for 10 years because they thought interest rates were going to stay low forever. And like, guess what? They didn't. So my moral of the story, coming back to what I said earlier, was never outsource your thinking. The smart money is not necessarily the smart money. A lot of those people are driven by financial incentives that are well outside of the investors' best interests. And as a result of that, pricings had to see a huge adjustment. So the only way that we were able to buy a deal last year was we bought it with a loan assumption at a higher interest rate. And that way we bought a higher cap rate deal. And it's quite technical to get into everything around that. But essentially the market was moving lower and lower and lower. And deals are trading at say, some of them are trading in strong markets like Dallas, Fort Worth, and Miami. And, you know, New York was actually quite weak coming out of COVID. So they weren't at high cap rates, but they were 3.5% cap rates and they were borrowing at a 3% interest rate from the bank. And today you can't touch a 3.5 cap rate deal because interest rates are at 6.25. So the whole market's starting to reprice based on higher interest rates and based on lack of liquidity in the market. So America's in a unique situation where they've got private households, companies have got more cash than they've ever had historically. The average household net wealth in America is $750,000. Just let that sink in for a second. Okay. And cash reserves across businesses are almost $4 trillion. So it's the highest it's ever been. But everyone's sitting on their money waiting. Okay, because of the news that you're referring to early on. So there's sentiment, there's news, no one's sure what's going to happen. We don't know where the Fed's going to stop when it comes to interest rates. And as a result of that, people are sitting on money. So when that money comes back into the market, cap rates are definitely going to start to compress again. No one can sit on cash forever, especially when inflation's going the way that it's going. And I'm a strong believer that real estate and apartments specifically is some of the best places that you can put your money into during inflation, especially when there's a housing shortage of 4 million apartments. And when, as a result of the uncertainty, permits are down, construction application for permits are down almost 80 to 90%. That single family, that's multifamily, that's everything. So a lot of the people that were building into a very strong market last year are going to complete their buildings this year. Into 2023, as I mentioned, they've got the most apartments ever coming into the US market being constructed. that's definitely going to put some strain on the market and reduce rental and have a little bit of a supply-demand imbalance over the short term. But in 2 or 3 years or 4 or 5 years' time, specifically, because so little construction's planned and approved, and we've already got this housing shortage and deficit, there's going to be an immense amount of pressure on rental and on demand for housing. And that's why I'm extremely bullish. We're not waiting for smart money to enter the market. When smart money enters the market, it's too late. I used to bid on offers. There would be 30 other bidders at the table that I'm competing with. Today, there's maybe 5, if they're lucky, that are also submitting offers. So that's why I believe now is the right time. I don't know when's the bottom, but in terms of dollar cost averaging into the market over the next 3 to 18 months, I believe is an extremely wise move. And inflation's your friend. So I'm going to come back to getting caught with your pants down. I've jumped to the next point. You can hear I'm a bit passionate about it. But coming back down to the fundamentals is there's a severe supply and demand fundamental that hasn't changed. Okay, it remains unchanged. The only thing that's changed is interest rates. And interest rates happen in debt cycles and market cycles. Someone else was talking about Ray Dalio early on. I'd highly recommend reading his book on debt cycles over history. He's got a recent article that came out yesterday on LinkedIn that gives a guide onto where things are going with Silicon Valley Bank and the decisions that the Fed needs to make. If you're interested in geeking out on that stuff, don't need to. But I think that it's important to be aware of the fact that debt market cycle and that we're currently in a higher interest rate environment over the short term. And I think it's going to go a little bit higher, possibly worst case, I say in inverted commas or quotation marks, because the worst case could always be worse than what I'm saying. But I think there's probably another 100 basis points to go in interest rates going up. But if I can buy a deal today that just about cash flows, and my interest rate is fixed for the term of the loan, which most of them are in America, except for those that got caught with their pants down, but we'll talk about that shortly. Then in that situation, inflation is going to be my friend, time is going to be my friend, and pricing is going to go up. I've never in my life seen construction costs come down over the long term. They've already gone up astronomically, and they're going to continue to go up over the next 3 to 5 years while tools are down and while construction slows. And when it eventually comes back, it's only going to come back if it makes sense on the rental income that developer can develop to and still make a spread on what he's developing to as a cap rate versus what the market's able to pay. So in other words, just a profit on what his costs are. And for that to happen, there needs to be a lot of rental growth at current interest rates over the next 5 years. Either exorbitant rental growth needs to take place or interest rates need to come down. In either scenario, if I buy today, I'm in a good space, because if interest rates come down, then my cap rate should come down again, and I can refinance at better debt terms than I could today and pull out a lot of equity. If interest rates don't come down and they come up, eventually there's going to be a supply-demand imbalance that's so strong, rents are going to have to go up. So that's my view, and I would highly encourage you guys to get involved in the market if you're prepared to hold for 5 to 10 years. If you want to make money in the next 2 years, anything could happen. So that's my sentiment around the property space. Coming back to getting caught with your pants down, Zen Garden Apartments. Let me see if I have it on the next slide. I don't think I do. Yeah, I didn't have it there. Okay, so Zen Garden Apartments, as an example, was a development where the developer was out of the ground in June last year. He went under contract at $280,000 per unit. This is 203 apartments. Okay, it was under contract at $280,000 a unit. Pay attention to these numbers. And he kept delaying the closing because he wanted to have his next development lined up to deploy the capital into, rather than closing today, needing to pay capital gains tax potentially, and then rolling into the next one. So in America, you have something called a 1031 exchange. I don't want to get into that because of time constraints, but it allows you to defer your capital gains tax if you can trade within a certain time period. And so this developer wanted to have all of his ducks in a row and lined up. As a result, he, as the seller, kept extending the closing of the sale which is really unique in and of itself. And the purchaser went right up with him, extended for 5 months from the closing date that they were meant to close. It was actually a bank that was buying the transaction, so they could hold their interest rate, which no other buyer would have been able to do. And then 2 days prior to closing, they got a mandate from the bank, pencils down, don't buy anything. They walked away from a $300,000 deposit, and now this guy, we're putting offers in at $220,000 a unit. So and this happened in less than a month and a half ago. So this developer could have sold for $280,000 a unit. He wanted to wait. Now he can only sell for $225,000 a unit. He has construction debt that's coming up that's maturing. His debt was a floating rate loan because most are with construction. So he took out the debt at 3%. Now it's sitting at 6%. He's bleeding. And he's got his deposit on his next purchase for the next construction site that he has. So this guy literally doesn't have a choice but to sell at a discount. And the reality is, even at a severe discount of $230,000, it's very difficult to make the deal work because interest rates are now at 6.25% and not at 3.25% anymore, which is where he priced it to. So this is happening all across America at the moment. And that's why our strategy has changed a little bit from focusing on value add product to actually trying to be a little bit more aggressive and opportunistic on new development product that's coming out of the ground, because they're just happy to exit at a small profit or no profit, rather than get stuck with an asset that they need to manage because they're generally merchant builders. They've got their next development lined up, and they've got construction debt looming over their heads. And another important aspect of
No, what I'm hearing is I haven't heard this from you before. What I'm hearing is what I saw in 2008, 2009, 2010, which was the concept of a vulture fund, which is where if you've got cash that's available quickly, it's incredible the opportunities you can buy off new developers when they've been caught with their pants down.
Absolutely. So, and the reality is when the interest rate environment settles again, this deal should sell at $280,000 a unit like it was about to before. It's just because we're in an extremely volatile period now. Everyone thought interest rates were going to stay low forever because, to be fair, that's what the Fed said. They were very clear that we're in a low interest rate environment for the long term. And then suddenly things changed. And that's what's happened in this situation. So another example is a little deal called Aqua 550. It was called the Rialto. I'll pull it up for you over here as an example. So this is what an offering memorandum would look like from the broker. We try to buy this building for, I think it was just over $6 million. At the time, we got outbid by $100,000. I was really sulky about it. And lo and behold, the reason they were able to pay so much because we already felt like we were stretching pretty thin, but they made use of bridge debt, which comes back to my financing comments. So they took a way higher loan to value loan, but it was also a floating rate loan. So returns are great on paper, and even though the net operating income's kept up exceptionally well, I think they're outperforming their business plan on the net operating income. The reality is that they now can't get a new loan at an interest rate that makes sense to exit their old loan. So they would need to do what's called a capital call. And as a result, we've got offers out on this property now. They wanted $7.5 million. We've basically offered them the initial cost that they had, plus the renovation cost that they put into the building. So they can get out, with their hands clean, but they'll make no profit after doing a really good job actually over the last 12 months. So these are live transactions that we're working on right now. We'll hear back from them tomorrow actually. But just as an example, this is like a older multifamily block. And then some of the more development related things we're looking at would be Chisholm Point, which is actually in Oklahoma. I'm shopping in Infinity territory, Scott. So this is a build to rent community. We'll be taking this on directly from the developer if it all comes together. And here the value add is really the lease up. So properties fully leased are worth more than they are empty. And so we'll be buying at a little bit of a discount from the developer. I think he's literally getting a development fee and the rest is basically cost. He's not making much profit, but we'll take it off of his hands. We'll take on the lease up risk. And for doing that, we get it at a slightly lower price point. And so this is an example of an opportunity that we're working on now. It'll be staggered in phases and closing probably from the end of November. So, so if you're in the multifamily space, end of November is actually a bad time to take over and do a lease up. It's right in the middle of heading into winter, but we're pretty confident around the product. Springtime's always best for leasing. So yeah, I just wanted to share these little live deals with you. This one's not so little. This is a $40 million purchase. The other one was $6 million. And then as an example of a much smaller deal. So we also work with smaller investors, guys that have 1.5 to, well, not so small, but people with say $500,000 to $1 million will offer a boutique service to them where we can just help them buy properties themselves. This is a deal we went under offer with last night, actually. So this is in Florida, in Sarasota area, so south of Tampa, north of Naples. I don't know if you're familiar with it at all. But yeah, these are some of the smaller deals. So as you can see, there's quite a variety of projects that are available in the multifamily space. This is 13 units, other one's 216. The largest offer I've ever submitted a deal on was 990 units for $103 million with another group in America called REM Capital. So these things can honestly be monstrous. Like, you can't believe how big they are. It's a little city on its own in some cases. All right, guys, that's it for me. If there are any questions, feel free to fire away.
Awesome. Thank you, Ricky. I appreciate that a lot. I know Graham had to duck, and I think Derek had to duck as well. There's lots of very positive comments that have come through from both of them before they ducked. So, yeah, firstly, but what I'd like to do is just not necessarily questions, but just comments around what you've just heard. I just want to say from my side, actually, no, I'll go last. So yeah, do you want to stop sharing, Ricky? I can link it just so we can see people's faces. I can link anyone with me. I'd love to know people's feedback. You know, that was very comprehensive for the last nearly 2 hours. And so and I'm sure, again, I want to repeat, I'm sure quite overwhelming, but 10 years worth of knowledge into 90 minutes is always quite tricky. So who wants to go first? Anyone?
Scott, from our side, thanks, Ricky. That was great. Extremely, like, lots of detail in there. And at some points, Carrie was going, "Are you getting this?" And I was, "Nope." That's why I link up with Scott, who links up with you, and trust you guys. So it's great to meet you. What it does do, though, is even though I don't understand quite a lot of it, I get the principles of it. It's good to know that. But it does inspire me with confidence that you know your stuff. So I know that if we were to invest there, our money would be as safe as can be, and that you've done a lot of due diligence. So thanks for that.
Thanks. We
have actually invested through the Wealth Migrate platform on that deal you brought up, Scott, with Brendan, with Infinity. Yeah. And yeah, to the others that haven't invested in this area, it's been fantastic. You know, we've received our dividends. It's been awesome. So it is a really good asset class.
They're great. They're really great operators. The guy that they got in their ground there, that they partner with, used to work for a group called Equity Residential, and they're like the first REIT in America that did multifamily apartments. The guy's name's Sam Zhao. It's like a legend in the industry. So, so the guy that they partnered with he's a really strong operator. They're good guys.
Cool. Thanks, Kerry. Appreciate it.
Yeah, from my side, Ricky, thanks very much for that. It's a lot to think about. I've actually been involved with Brendan way back on some of the work that he did early on. So it's great to see him also grow and you guys grow. So I know you know what you're talking about. It's clear from some of the work I've done with them that you understand the bigger picture. And I do believe that the multifamily space in America is quite a hot area. I mean, you get some big guns in that space, right? Guys like Grant Cardone and those guys, they're also quite heavily invested in that area. So yeah, there's I think it is definitely a growth area. And it is good to know someone that's in that area every single day and that does deals every single day, because I think you have to be on top of it the whole time. For small guys like me who will do a deal every now and again, that's you can't get across all that information. So it's good to partner with guys like you. Thanks.
Awesome. Thanks, Volker.
I'll go quickly.
Yeah.
Ricky, thank you very much. Lovely to meet you, and very interesting information. I must say, for me, it's a little bit all overwhelming, but I guess that's why it's all in a partnership. So that's all good. Thank you.
Maury, it's always a balance for me between these things being overwhelming versus, if you remember what we said, is over a 12-month journey on the Mastermind. By the end of the 12 months, you've got, and I think, Kerry, you've summed it up quite nicely. You don't necessarily know everything about every asset class, but you've now got a much better understanding of what multifamily is and, et cetera. And it just helps you as an investor, versus blindly. And I love Ricky, I've written it down here. It's the quote of the day: never outsource your thinking. Because for me, at least you've got an understanding, versus just handing your money to a financial broker that's just putting it anywhere, Bucks, what did you think? Your first, I know you're in the big, very much a property investor, and I don't know. This is obviously, I don't know if it's new to you. What are your thoughts on what you just saw?
I thought it was good material. Nice to meet Ricky. And as you're saying, we are also in the property investment. This would just be doing this for ourselves outside the country. I guess just a little bit more to learn about basically the behind the curtain stuff that happens overseas as compared to understanding your own market in Johannesburg and in South Africa. I think that's where it starts to become, that's where the difference only becomes, because sometimes it's the little bylaws that just catch you if you try to do this by yourself. I think that's where you can fall short. So very interesting to see some stuff. Just as you're saying, some of the areas you want to know what you're investing in. I've heard a lot of Section 8 from a lot of people. I've got cousins in the States. I've got family overseas. So it's just getting a professional to tell you more than obviously people that are overseas that are not in the property space is better. Because everyone will just give you their little crumbs of what they think they know, as opposed to speaking to some experts. So I think very informative and interested to engage more.
Awesome. No, thanks. It reminds me of a story, Ricky. And there was a guy selling houses in South Africa, sort of 2010, 2011 in Atlanta. And on the one side of the street, so again, all of us can go and use Google and whatever, and we can look at price points. And on the one side of the street, your kids could go to the good schools, and on the other side of the street, your kids could go to a different school, which happened to be the third worst schooling district in the whole of America. Same street, huh? And the South African guy was selling houses to South Africans on the wrong side of the street, because we wouldn't know. I mean, why would this house cost 100,000 when this one over here is 150? Same street. You think you're getting a deal. But no one wants to live in a house, not a tenant, not an owner, no one, if their kid goes to the third worst schooling district in the country. But we're never going to know that, back to your point, Bucks. Never, unless you're on the ground. So if you're taking the advice purely from the agent, kind of giving you the advice, and again, on paper, these things looked amazing. But I'll never forget, and I've got a video, basically, if you want me to share it with you, where we literally went with our local partner on the ground, and he explained the difference between the two. And it was an eye-opening watershed moment for me, because I realized how simple that type of information could be, that I would never even know what to look for. Like, do you know what I mean? And that's where I always come back to partnership, because it's impossible to do it all yourself. It's impossible, from my experience. I don't care if you got $100 million. So Shane, just a closing comment from your side. I know this is also a lot of new stuff to you, but yeah, your thoughts.
Yeah, for sure. Thanks, Ricky. It was extremely valuable. A lot of new information that I've also learned today. Yeah, while my mind was busy snapping, I was trying to think of how we can make sure we get this information to like newcomers that are coming into this journey with a Mastermind, and because I think it's extremely valuable to learn this asset class. And then how we can kind of get the new information as it comes along, and get you back to kind of share with others.
Awesome. So
thank you.
Yeah, and so from my side, Ricky, I just want to say on behalf of everyone, thanks very much. I can see that was incredibly comprehensive. Just by the way, Ricky didn't have some PowerPoint that he just came here and turned up. He actually built that for you guys. So I deeply appreciate the hard work that's been put into it. And I mean that with full sincerity, Ricky. That was super comprehensive. And I'm sure, like Mari,
thank you,
and myself and everyone in between, I learned a hell of a lot there. And it's like, wow, I need to go back and look at this. But I also want to give you comfort, Mari, and anyone else listening to the recording. We don't need, again, I'm going to keep repeating what I said. We don't need to know all of this stuff. We don't. We just need to have a general overview of it. It's quite important to know the difference between a core and an opportunistic deal, as an example. But we don't need to know whether we've got to look at the LP agreements of whether it's return on capital or return off capital, because quite frankly, that should be being decided by the quality of the partner to start off with. If we're going to that level of detail as individual investors, I virtually guarantee you we'll lose. If we're trying to do that in every sector, in every asset class, in every country, which then moves away completely from why we're part of this mastermind, which is about diversification. So that's kind of my take on it in general, basically. So yeah, no, Ricky, I really appreciate it, and I look forward to you bringing us some good quality deals. Basically, is the honest truth.
Yeah, we're trying our best to find them. It's definitely difficult in this market. Those that can hold will continue to hold until things stabilize, and those that are forced to sell are still hanging on for as long as they can. So we'll see.